Hello everybody, it is Michael here from iRetirement Trading, and today was a very special day. I had my first interview ever, and it was with Mike Khouw from YieldMax, and he was pleasant on and off the screen, and there is a bunch of nuggets that people may find helpful in this video. So let's get into it. Hello everybody, it is Michael here, and today we got a special guest, but before I get into this, I must state that this is not financial advice or a recommendation, and it is for entertainment purposes only. Well, recently I went to New York City for the Blossom Social Investor Tour, and they were sponsored by YieldMax as one of their sponsors, and I met Hunter from YieldMax, and he hooked me up with the connection of today's guest, Mr. Mike Khouw, strategist for YieldMax. Welcome to the channel.
Thank you, Michael. It's great to be here.
And Mike, can you tell us a little bit about your background and how you got to YieldMax?
Sure. My background is in asset management and most specifically in options trading. I actually started as a floor-based options market maker on the Philadelphia Stock Exchange in the 1990s. We made markets in several single stocks, probably about 150 single stocks, and also we made markets in cash-settled indices, which was kind of a precursor to ETFs, interestingly enough. My first product was the Oil Service Index, which was one of the industry sector cash-settled indices on the Philadelphia Stock Exchange at that time that you could trade options on. After the Philadelphia Stock Exchange, with the same firm, I moved to the American Stock Exchange in New York and worked on that floor for a couple of years before then moving with the same trading team, although not the same firm. That firm was sold after September 11th, and the team moved to a different firm. I was then trading oil and natural gas options on the New York Mercantile Exchange. After the New York Mercantile Exchange, I worked for a buy-side firm, a hedge fund based in Los Angeles, deep dive, fundamental approach to long-short equity, and then on to Cantor Fitzgerald, where I ran the institutional sales and trading business in the U.S. on the listed derivative side for a couple of years. And around that time, CNBC approached me about doing a show about options called Options Action. We did that for 16 years every Friday night. So that was interesting. Published a book by Wiley called The Options Edge in 2016 with one of my work colleagues and still a good friend, Professor Mark Guthner of Rutgers University. And, I'm going to say it was about 6 months ago, I was doing a video on my YouTube channel talking about options-based ETFs, and most specifically about one of the YieldMax ones called Misty. What I didn't know at the time was that several people from YieldMax and from Title Financial Group were watching that video. And right after we wrapped up, they gave me a call and they said, you seem to be pretty conversant in these products, and you have a background in options. What do you think about coming over and joining us? And obviously, in the course of that conversation talking about the product, I could see that they'd kind of captured lightning in a bottle. And so it seemed like a good fit. That's kind of how it all came together.
Very cool. Myself, I used to trade options a lot, and this basic wheel strategy, just selling cash secured puts and covered calls. And I did okay at it, but I found out that there was companies such as YieldMax that trade these options for you. So they do the work for you, basically. Is that one of the reasons that YieldMax came out with these products?
Yeah, I think that's almost exactly why it happened. Covered calls is a strategy that's been around pretty much as long as calls have been around. And, the only challenge with it is that if people don't do it for a living, especially now that they have things like weekly options and so on, it can be logistically challenging, to adjust, to roll as options expire, as the underlying rises and falls. So that's one of the logistical challenges that individual investors can have. And so, Michael Venuto and Jay Pastricelli, they, came up with these products essentially as a way to democratize selling covered calls for individual investors in a, as tax efficient a wrapper and easy to trade product as you could. Now, there's another important reason why the ETFs actually have appeal for some investors rather than doing it themselves. Imagine, for example, that you're trying to do covered calls on high dollar stocks. We're talking now about, whether it's Tesla or Nvidia, and they're trading for hundreds of dollars per share, and you want to have a diversified portfolio of covered calls in a variety of stocks that you like. If all of those stocks are trading in the mid hundreds, so they're $30,000 to $50,000 per what we call, a lot, because each options contract represents 100 shares. So you would need to have at least 100 shares of each one of those. Suddenly it becomes pretty capital intensive, and it becomes harder to balance the amount that you want to have in each one. By creating single stock covered calls, ETFs, it basically meant that you could deploy, as little as $20 or $30, to the strategy, and then you could, position your portfolio accordingly, and then it would essentially be managed by the pros on the trading team. And that was the whole idea, democratizing a product that might be a little bit harder for people who are just starting, people who didn't have options permissioned accounts or didn't have a lot of capital, gave them access to the strategy, and then they could choose the stocks that they wanted if they wanted.
Yeah, that sounds good. That's true. When I was trading SPY options at the time, I'd have to have like 40 grand worth of capital at the time. What about let's talk about ULTY and YMAX.
Sure. So these two are diversified funds. They take a slightly different approach in each case. So YMAX, for those people who want to have access to the single stock covered call ETFs but don't want to pick which ones they're going to invest in and want to basically just have a diversified exposure to them, you can buy YMAX. YMAX basically buys a basket of the single stock covered call ETFs. It has the benefit that, there's basically one fee charged. So you're not, basically having to pay, the fees to the YMAX fund as well as to the individual covered call funds. But then you can allow the trading team essentially to give you that diversified exposure. Just buy one security and get the whole basket. ULTY is slightly different in the sense that ULTY actually trades the underlying stocks, and it can do something called a call strategy. And a collared strategy, which means that there's some downside protection put into effect. So for those who don't know what a collar is when you sell some upside calls, but you also buy some downside puts or put spreads to essentially mute the effect of downside moves if the market starts to roll over. So you get some measure of protection there. And you can structure this in such a way that you still are collecting premium. And that's basically the idea with ULTY. So both of these are diversified. Both of them are looking to have a positive carry. But one of them uses the covered call ETFs, which themselves use synthetic versions of the stock rather than the stock itself to affect their strategies. That's related to what's called the 40 Act. It's something that applies to the diversification rules of registered investment companies. And, ULTY actually trades the common in these things. It can do so because of its diversification, it doesn't have to trade synthetics the way the single stock covered call ETFs do. So, they're slightly different strategies, but, they both have merit.
So just to be transparent, I am an investor in ULTY and YMAX myself. I own both of those. So you're saying that ULTY owns the underlying and YMAX doesn't, basically.
That's correct. Yeah. I mean, the thing I think it's important for folks to understand, maybe we should just talk really briefly about what synthetics are so that people understand, what you do have and what you don't. So the reason that the single stock covered call ETFs trade synthetics is because registered investment companies And that's what ETFs are. So they're regulated by something called the 40 Act, as are mutual funds and so on. There are certain diversification rules. They can't have excess concentration in a single security, right? So because of that, if you, let's say you had $1 million in a fund and you bought $1 million worth of stock in a single stock, you would already be violating that diversification rule. Now, the exception to these concentration rules are cash and cash equivalents. Things like U.S. Treasuries, for example, don't count for that. So what you can do is you can get synthetic exposure to a stock by buying calls on that stock, selling puts on that stock, fully cash covered by U.S. Treasuries, and then the actual exposure, the options exposure, is not going to essentially violate that registered investment company diversification rule. And so that's the reason the single stock covered calls are structured this way. If I own a call, let's say it's a $100 stock and I own the 100 strike call and I'm short the 100 strike put, I'm effectively going to be long that stock, or I'm going to have exposure that's very similar to being long that stock, regardless of what happens to that stock. Because if the stock goes up to 110, I can exercise my call and I can buy it at 100. If the stock falls and it goes to 90, the call isn't going to be in play, but I am short a put and I'm going to be assigned the stock and I'm going to have to buy it at 100. So either way, I'm going to end up buying at 100. The principal difference between a synthetic position and a position in the underlying is that you don't, for example, if the stock pays dividends, you won't receive the dividends in the synthetic version where you would if you actually held the common. Now, most of the stocks that we trade, we have mostly growth stocks, in our portfolios, and most of the covered call funds are also on what we would typically refer to as growth stocks. Growth stocks don't very frequently pay dividends, but even if they did, it probably wouldn't make a huge difference because there's no arbitrage in the markets. So basically, if a stock pays a dividend, the synthetic variant of that, the price of that will reflect that dividend, if that makes sense. So, that's really what's going on there, and it's not anything other than just a way to give people the exposure that they want within the confines of the rule set that applies to ETFs.
So I've heard before, like listening to other interviews and stuff, that Jay said that ULTY is the closest thing that you all have to a hedge fund. And can you talk about that a little bit?
Sure. So one of the things that ULTY has, the covered call ETFs are very straightforward. The exposure to those is comparable to buying a stock and then selling weekly call options on it and adjusting them as needed on the way the stock moves and things like that. So you have to move the strikes up and down. And of course, as the options expire or approach expiration, you cover the expiring ones and roll out. ULTY, on the other hand, can do more sophisticated things. So it can hedge. So you can sell calls, you can sell call spreads, you can sell ratio call spreads, and you can buy downside puts or put spreads to get protection to the downside. So there's a lot more flexibility and discretion within ULTY from the portfolio manager's point of view. And depending on one's perspective, that's some people like a more vanilla probably isn't a fair way to characterize it, but covered calls are a very straightforward and time-tested strategy. And what ULTY is doing with collars is also sort of well vetted by this time, but it is slightly more sophisticated. There's more moving parts to it. But there's a benefit to doing that as well, because I think most people probably are interested in trying to collect a little bit of income and also hedge the underpinning assets that are used to support that.
So ULTY has been paying about 9 cents a week in recent times, pretty consistently. I consider that very good. What is your opinion on dripping the distributions or just taking all of them?
Well, I think that depends a little bit on one's, needs and desires. If you're using those distributions to, reallocate, for example, which can be, something that people can think about. So, for example, if you had exposure to a single stock covered call ETF, maybe outsized exposure to it, and you get a distribution that exceeds the NAV appreciation, do you take that distribution and reallocate it to other investments, or do you reallocate it back to the original one? That depends a little bit on whether or not you still have a strong view. So let's just take a single stock, one like NVIDIA, for example, NVIDIA. So if you held NVIDIA and you get a distribution from NVIDIA and you're thinking, okay, what percentage of this should I reallocate? Well, you can take a look at the change in the net asset value relative to the prior period, the last time you got a distribution. And some portion of that distribution that you got may have come from the call income. Some of it may have come from some capital appreciation that was realized. But if NVIDIA has fallen, but you're still bullish, you might choose to increase the amount that you reallocate to it to take advantage of the fact that the underlying stock is lower now, right? On the other hand, if you were very bullish on NVIDIA, but maybe you're a little bit less so now, you take that distribution and maybe you want to allocate it to something like a more diversified product, like ULTY, for example. But the way I would look at it is, I would like to track and actually you can see, and we have something called Target 12s, which is another series of ETFs. Biggie is one, basically tracks the top 50 largest companies. So it's, kind of think of it like the top 50 in the S&P, if you will. It tends to make smaller distributions, and so it has more capture of appreciation in the underlying assets. In fact, actually, I'm just going to take a quick peek and see where it is year to date. So I just have some basis to talk about it. Actually, yeah. So year to date, if you had reinvested all of the distributions, it's up about 13.73%. If you had just taken all of the distributions in cash, you'd have had a total return of just under 13%. And then the underlying assets have also grown, so the per share price is up, just under 3%, right? So it's sort of keeping pace with inflation, if you will. So, my attitude about it is that if I was looking at a portfolio that I wanted to have collecting income, I would want the invested capital to grow at about the pace of inflation, or hopefully a little bit more if I didn't need to spend all of my distributions. And so that's how I would think about my DRIP, my dividend reinvestment plan, which is, okay, let's just take a look at the total net asset value that I hold and trying to keep that stable to growing slightly, and then live off of any excess distributions net of that, if that makes sense.
What would happen if somebody was to take all the distributions?
Well, it depends on which fund, right? So some of the funds have appreciated and the net asset value has declined. In the case of Biggie, which is the Target 12 I was just talking about, if you took all of the distributions this year, and so this year this one is still on a 4-week schedule, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there have been 10 distributions so far. The first one took place on January 7th, and the most recent was on October 7th. So if you took all of the distributions in that one, you would have had 10 distributions, and you would have gotten approximately 1% per month of your assets, right? And the value of the underlying shares have also appreciated since the beginning of the year. So at about the pace of inflation. So that is essentially that one is taking care of it. Now, if you take a look at ULTY, for example, ULTY, I think the performance is a little bit better, right? But this is so ULTY is up. The total returns, if you had reinvested, is 19.55%. If you had not reinvested at all, is 11.44. So in this case, but the share price is down about 40%. So what you would have wanted to do in that case is take, we could say, 40% of the distributions, if those had been reinvested, then you would have ended up with, a return characteristic that was arguably a little bit better than Biggie probably, and you would have had share price mild increases in the net assets you had invested in that fund. Your share count would go up, of course, because every time you take a distribution, maybe you buy another share or two, whatever, of YLTY, with your distributions. So your share count would go up, your net asset value would remain relatively stable or increase, and then you could use the excess distributions for whatever you saw fit.
About 40% this year would have kept it stable.
Yeah, I mean, I'd actually have to model it out, because one of the things you need to do, there are circumstances where if, prices increase, you may not need to do anything. If you take a look at the post-Liberation Day low, so that was, around April 8th, for example, of this year, the share price is essentially unchanged since then. Right. So, if depending on the time that it's going to vary for every single person. You just need to sort of keep track of, okay, well, what's the net asset value of my account? That's really going to tell you the story, and how much of it is in cash, how much of it is invested in the various stocks, ETFs, and other things that I hold. You're trying to keep your investment capital stable to growing if you're living off of a portfolio of assets for purposes of income, right? So that's really I think the objective that most people should want. If you look at pensions and trusts and endowments, they're trying to manage their affairs in a way that it's going to be, sustainable over the long term. And they'll reallocate as needed to make sure they accomplish that.
What about with YMAX? Can you pull that up?
Sure. Actually, I don't know. Are we able to do screen shares with this application?
Not really 100% sure. So.
Well, I think we might. I'm going to take a look at. I don't know that you use sophisticated software for your videos, so
yeah, probably not.
There is something that says share. It looks a lot like Zoom to me. So maybe that would work. We'll see here. But if we take a look at YMAX, since the same period, so I was looking back to the Liberation Day lows. I don't know if I can share this or not. I'll try to share it. We'll see what happens. That would be kind of cool, I guess, if we could do that. Let's see here. There we are. I don't know if you're able to see anything when I do that.
Yeah, I can see it.
So YMAX, from that same Liberation Day low, it's up over 40% in that period of time. The share price is also higher over that period of time. So if you had simply taken the distributions and spent all of them, it wouldn't have made any difference. I think it's probably more fair to go back to the beginning of the year. So the annualized rate of return, 20%, 16% total return since the beginning of the year, which is not bad. 11.73 if you had simply taken the distributions and put them into treasuries. So where would you be reapplying it? Well, you would have been reinvesting as prices fell. So you can sort of see that, and which is kind of a common approach. If you dollar cost average, when do you want to buy more stock? You typically want to buy the dips and, shall we call it, sell the rips, right?
Right.
In a situation like this, where these funds distribute the income that you're getting from, selling premium, that means effectively that there's some capital gains that are going to be baked into the distributions as well. In those cases, you don't actually need to do too much dividend reinvestment. So you can see you would have been buying as it fell, but as it rose, there wouldn't be much need. So oops, I have to go back to 2025 here. So you can see in the post-Liberation Day period, the capital base grew even net of those distributions, right? You can sort of see that on this chart here. So the white line is the price of the ETF, which has been quite stable. through this period of time. I mean, it's risen and it's fallen, but since that post-Liberation Day low, it's still higher, and it's distributed 42, 35. It's about 35%. So if we take the price change and we deduct that from the dividends reinvested at the cash rate, that tells you effectively what the distributions have been. So since early April, you're looking at just that period of time. So it's we're not quite on the 8th. If I went back to October 8th, then we would be able to say, okay, well, that's exactly half a year-ish or whatever. But you're looking at distributions in the neighborhood of, round numbers, 35%. So 35% distributed, 7.6% capital appreciation. If you had just taken the distributions in cash and done whatever, not reallocated any of it. That's this lower number down here. I don't know if you can see my cursor. Oh, you can see it. Yeah, so you can see so this number right here. So this up here, this is the price appreciation of the shares. This is how much you would have had in returns if you had reinvested the dividends back into YMAX every time. And this is how much the total returns since April 8th would be if you simply put them into, say, a money market account. This is the interest rate assumption over here. If you can, yeah. So 3.94% is the interest rate assumption that this Bloomberg terminal is using to do that calculation in this case.
One thing that I was surprised, being I have this channel, I do a lot of research, and I was actually surprised that I compared YMAX and ULTY to like the SPY,
Mm-hmm.
and it outdid it in year to date and in 1 year. I believe it was
yeah. I mean, we see this same thing that we're looking at right here. I can do this exact same calculation for. So if we go back to, well, let's just look. I mean, I think most people like to look at things sort of year to date. So the year to date total return for SPY is 13.74% if you had reinvested your dividends. Now, granted, SPY doesn't pay very much in distributions, right? So they've only had 3 and they're de minimis. So, yeah, if you're looking at these, then you can see that YMAX outperformed. The total return if you'd reinvested here would have been 16% versus 13.7. We'll round up 13.74. Give SPY the benefit of the doubt. And if we look at ULTY, I'll go to the same period. Oops. Wrong year. So the total returns for ULTY are 19.6%. So yeah, both have outperformed SPY on a total return basis pretty comfortably. YMAX outperformed by 225 basis points or so year to date. ULTY a bit more, right? So 19.58 versus 13.74. So almost 6% outperformance year to date for ULTY.
So in YMAX is something similar, very similar to that, or?
Oh yeah, well, YMAX is this one 16% if you'd reinvested the dividend, so that's outperformed by 225 basis points, 2.25% ish.
Right.
I mean, these things are ticking, right? So I mean, don't hold me to a basis point one way or the other while prices are moving.
One of the things I've been seeing, like on all the forums and stuff, Blossom, etc., is everybody saying that YieldMax is going to all your monthly payers are going to weekly payments on your single. Is that true?
That is, yeah, it is true for all of the single stock covered calls. We announced that last week. Some funds, like the Target 12s, are on the monthly schedule still. But everything else has switched to weekly. It seems like there was a lot of demand for that. And, it puts more flexibility in the hands of of the individual investors. I will say, so for those who are looking at these, I think the important thing to understand is that we had 4 tranches of 4-week payers. They weren't actually monthly payers. They were paying every 4 weeks, and there were 4 tranches of them, A, B, C, and D. So as those transition to weekly payers, there's going to be some lumpiness in the distributions, and I think people need to be aware of that, right? Because if you had one that paid a distribution, let's say 3 weeks ago, and now it's transitioning to a 1-week, there's going to be some, we'll call it accrued distributions that get paid before it sort of smooths out and goes to the more regular weekly amount that you would expect to get based on whatever options income was generated in that week, right? So for the few weeks that we're going to work through the various tranches, there may be a little bit of lumpiness, and some of that lumpiness is going to flow through to YMAX, right? Because the distributions are going to be going into that. But with respect to ULTY, which was already, it's not going to have any impact. That's a sort of standalone strategy. But yes, the covered calls are going weekly. I think this was, somebody described it on one of the X Spaces recently as one of the worst kept secrets. I think a lot of people were aware that a lot of folks had asked for it, and a lot of people saw that there were some filing changes that YieldMax had filed to have additional flexibility with respect to the timing of distributions. The challenge for us, of course, is that we knew that people had asked for it and we had filed to do it, but the way the rules work, we can't talk about anything until it is actually approved. So, folks who are following what was going on probably had made the educated guess that we were going that way, and that is indeed what happened.
Is there any new products that you are allowed to talk about coming out?
So we're limited to what we can talk about, to what we have filed that's basically in the public domain, as you might expect. Right. One of the things that folks are aware that we have filed for, and where there continues to be some where we're continuing to do work with the agencies. An example of this would be the Target 25s, right? So, a lot of people know that we filed to do Target 25s. The process is that you come up with an investment product, you file with the SEC to launch that product. They review the documents. There's usually sort of some question and answer period that goes on between the filer and the SEC. If they have questions or need explanation, or some things need rewording. And so there's still some back and forth on that. But unfortunately, I can't really, talk about things that we haven't publicly filed, as you can, sure, understand.
Right. All right. Well, I got one final question for you.
Okay.
If you could only buy one YieldMax product right now, which one and why?
So, as you did, you gave a little disclaimer right at the beginning, and you said this is not to be constituted as financial advice. So, 2 things about that. One, obviously, it shouldn't be you shouldn't sort of take this as financial advice. The other thing is that these are securities, so this is not a solicitation to buy any security. But I will say the following, which is that if you can only buy one, unless one has a really strong view. So the single stock covered call ETFs were specifically designed for people who wanted to run covered call strategies in those specific stocks. So if you liked strategy, what used to be called MicroStrategy, but if you liked strategy stock and you wanted to do a covered call on that, then Misty essentially gave that to you in a wrapper, in an ETF wrapper. Same thing for NVIDIA. You could trade something like NVIDIA, and you could get a covered call strategy in an ETF wrapper. The thing is that for a lot of people who say, I like the idea of running option strategies, but picking stocks is hard. And it is hard. You can take a look at the SPIVA reports and see how much professional investors sometimes struggle to outperform the S&P by choosing stocks, right? So if you're an investor at home saying to yourself, well, I don't know which stock to pick, I'm not sure that I want to take single stock exposure, then a diversified product would have to be one of the ones that you would consider. And we have several of those. Chippy is one. LFGY is one. So whether you're interested in AI or the semiconductor space. But if you didn't even want to go that far and said, okay, well, I'm more interested in the strategy and I don't even want to get industry specific, then you're going to start looking at something like a YMAX or an ULTY, which is a diversified fund. And the thing about ULTY is that ULTY has the ability also to introduce hedges as well. So that's not to say it doesn't have some exposure to equities. It does, of course. But there is some put purchases in there that are essentially a form of disaster insurance in the event that the market rolls over or does something nasty. It can mitigate that somewhat. And, I think there's more conversations about that recently. I'm not the only one saying it, I'm sure, but the market has had remarkable growth over the last several years. There was I saw a podcast recently, Howard Marks, who is the founder of Oaktree, big Los Angeles-based investment management firm. And he was showing a chart that JP Morgan had produced several, may have been a couple of years ago. But basically what it was showing was the average returns for the S&P relative to price to earnings that one paid at the time. And as one would expect, the average returns for the S&P per year is, over the last century, probably about 10%, maybe a little bit more actually now. But the problem is that it's not like the market chews out 8 to 12% returns year after year after year. Sometimes you have years where it's up a lot. Sometimes you have years when it's not up a lot. So the thing that ULTY offers is a little bit of disaster protection in the form of that downside put. And in addition to that, it has diversification. So I suppose that's probably the one that is most appealing to people who don't want to go out and pick a single stock and don't want to necessarily get exposure to the AI trade or the semiconductor trade or one of those things, because they're saying to themselves, boy, it's come pretty far, it's come pretty fast. I like the strategy. I want some diversification. And I, like a little bit more flexibility offered to the manager with respect to the options trades that they can use, to optimize their portfolio.
I really appreciate having you on my channel and answering a lot of these questions and for the interview. Do you have anything else that you'd like to add on closing?
Only that I really appreciate, what you and other people in your space are doing to help educate investors and, to invite me to talk to you and to them about it, because I think it's important work. And, there's a lot of misconceptions. There's a lot of misunderstandings about these products, about options in the marketplace. And the more people study them, the more they talk about them the way you're doing, I think the better off everybody is going to be. So I appreciate that, and thanks for having me.
Yeah, thank you for coming on the channel, and I've learned a lot, learned some things I didn't know. And on that note, until next time, catch y'all later.
Take care.